Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. Thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW, AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360 that comes to you daily, Monday through Friday at 3 p.m. and on Wednesday and Thursday at 2 p.m. And we're the host for your Wednesday 2 p.m. show. We, along with our co-hosts Joe Kuchera and Laurie Graymont, you get a different guest and different topics every day covering the vast and broad spectrum of real estate topics. And we try to cover it all for you. If you can't make the live show, you can catch our podcast on RE360radio.com. And you can catch my programs on TomWilsonProperties.com, which is the website for Wilson Investment Properties, or you can catch us on iTunes, also on YouTube. We have a great program for you today, discussing market trends, some of the latest data that's out on where things are, where things are going, with our frequent guest, Richard Crouch. Before we get to the program, just want to remind you that if you go to TomWilsonProperties.com, the Wilson Investment Properties website, the turnkey provider website, you can sign up for a newsletter on economics written by our economist friend Howard Blum. And in a short couple-minute read, you can get a great review and summary of what's going on in the world of economics as it applies to real estate. No obligation. Sign up for that, and that's a nice summary that you can get weekly. Also, you can request a report on how to select the best metro and product for investing. Let us know your questions, and if you'd like some free consultation on what to do with your portfolio or how to get started, we're glad to provide that as well. Richard Crouch is for those of you who have not heard him before, who's one of our great regular guests here. He's a engineer by education, Silicon Valley entrepreneur, an investor. He's a top producer with Alain Pinel Realtors in Saratoga, and he's an investment advisor representative for Transamerica Financial Advisors, and also a good friend and someone whom I always respect the input from because he does a great research and a great job at interpreting what's going on out there for us. Welcome back, Richard.
Thank you, Tom. Good to be here. And before I jump into the stuff I want to cover today, I'd like to give Keeping Current, KCM blog, credit for so much of the data that I come in here with. They do a great job of making sense out of a lot of this stuff, and you can find them on the web. So Keeping Current or KCM blog. I want to
before you get into that, I want to mention one other thing. We're broadcasting here in February of 2014 for our first broadcast, and want to let you know that KDOW is having a great Business and Money Expo on April 5, 2014 at the Santa Clara Convention Center from 10 a.m. to 4 p.m. It's a one-day, one location. Real Estate 360 will have a booth there. Wilson Investment Properties will be represented. And we will look forward to seeing you there, answer your questions. It's something that's becoming a regular event for KDOW, the Wall Street Business Network radio. And it'll be a live broadcast from there as well. We look forward to seeing you there. So today we're going to talk about market trends, what some of the latest data is, where things are going, what you can or should do about it. And now, Richard, over to you.
All right. Well, listen, one of the things I wanted to talk about, I think, is something that everyone has heard about in recent months, And I think it's safe to say nobody knows for sure what it all really means or what it portends for the future. And what I'm talking about is that word tapering, which you've heard and read so often about. Basically, the Fed, as in the past, as you know, has subsidized the real estate market and the lending market in order to stimulate the recovery of the economy. Now, because of that, recovery is starting to occur as we've transitioned from Bernanke to the new head of the Federal Reserve, that the first phases of tapering are actually starting to take place. And it creates a lot of anxiety for people. So I wanted to try and diffuse a little of that anxiety.
Although I thought it's fascinating that when Bernanke was still in last year, and he whispered the word that, they might start considering it, that the market tanked for a little while. But maybe what that did was to prep people a little bit. Now that they're seriously discussing putting some quantitative information on it, doesn't seem to be bothering folks. And, in general, our friend Dr. Doug Duncan, the chief economist at Fannie Mae, has always said, I'll give you my opinion and reflect the best data I have, but if anybody tells you they know exactly how this is going to play out, run like heck.
Well, yeah, not only that, but Doug Duncan recently commented that he didn't think the Fed would ultimately be troubled with a mortgage rate of 6.5%. So that kind of gives you something to think about. Mm-hmm. And if you look out, not this year.
Yeah, the operative word is ultimately.
Yeah, that's something that's going to happen, and it's just a matter of time. And hopefully, if it does happen, the economy's been strong, so in reality, we are still better off than if it didn't happen.
And my takeaway from that is some may react to it, and I think if he were, if it was in the context of the next year or two, that would be quite concerning, but he's not saying that. And I think, if we could all plan our futures assuming that a cap out there sometime would be 6.5 rather than 10 or 20 or 100 or something with hyperinflation, then I think that's something people can plan toward and deal with a lot more.
Well, let me just put in perspective tapering as it relates to what's happened in the past. That I think there's a lot of concerns from consumers what it means. Well, number one, it certainly means it's going to be a little harder, more challenging to get a loan. We've talked about that in the past.
And we're talking about the quantitative easing tapering
right.
from the...
Right.
Yep.
But I think it's important to understand what is the true story when interest rates go up. And if they go up dramatically, people worry that the real estate market would crash or that, that it would lose money. The value would properties would lose money. But the reality is, if you go back to May of 1983 to July of 1984, when the market rate went from 12.63% up to 14.67%, real estate portfolios increased by 6.6%. In 1987, all in 1 year, when the rates went from 9.04 up to 11.26, the market values went up 5.2. From October of 93 up to 94, December went from 6.83 up to 9.2. The value of the portfolios went up 1.2%. And finally, 1999, April to May 2000, rates went from 6.92 to 8.52, and real estate portfolios increased by 10.9%.
And under my gray hair is the memory that in the Carter years when they went sky high. And I think the perception today is that if interest rates and inflation goes up a little bit, the real estate economy crashes. And historically, that's a fallacy. It has not proven out in the past.
Right.
And it certainly has. Won't say it doesn't change the dynamics, but that alone is not a game killer.
Right. And I want to just right now quote a couple of pundits in the industry about the whole topic. Capital Economics, in their Housing Wire newsletter, said that the increase in November's non-farm payrolls, along with a drop in unemployment to a 5-year low of 7%, gives the Fed all the evidence it needs to begin tapering its asset purchases at the next meeting later this month. Whether such tapering occurs this month or early next year is questionable. The fact is that the mortgage rates will spike when it does occur, is more a guarantee. Now, here are the thoughts of a few Fed presidents. James Bullard, president of the Federal Reserve Bank. To the extent that labor market indicators continue to show improvement, the likelihood of tapering asset purchases will continue to rise.
When was that? When was that?
In committee's 2012 criterion for substantial improvement in labor markets gets easier and easier on a cumulative basis as labor markets continue to heal. Based on market data alone, the probability of a reduction in the pace of asset purchases has increased. Richard Fisher, Federal Reserve Bank of Dallas, in my view, the Fed should begin tapering bond purchases at its earliest opportunity. Consider this strategy desirable in its own merit. I would be more comfortable if we were to remove ourselves as much as possible from interfering with the normal price-setting function of financial markets.
My recollection is that he's always been one of the more conservative Federal Reserve.
Right. And finally, Jeffrey Lacker, president of the Federal Reserve Bank of Richmond. I expect discussion about the possibility of reducing the pace of asset purchases. The key issue, in my view, is the extent to which the benefits of further monetary stimulus are likely to outweigh the costs. So if you're thinking about purchasing a home, buying before the tapering will probably mean a lower mortgage interest rate than if you waited.
Okay.
And so what does this all mean? I mean, put all this in context. Well, there's a lot of predictions right now. For example, predictions for 2014 are that supply will struggle to keep up with demand. I think we can all relate to that because we see a very tight supply right now that's gone down since the headier months of 2013. And so the struggle to have enough inventory is an ongoing issue. And yet, housing predictions, the Urban Land Institute, for example, the Urban Land Institute, they're predicting, as is KCM, that the sales will surge in 2014.
Did they quantify that?
Yeah, this comes from 10 to 15%. This comes from first-time buyers, the move-up buyer, and the immigrant buyer. And the immigrant buyer is an interesting thing in terms of what if immigrants can buy homes. There's a $68 billion per year increase in the economy coming from real estate as a result of that. So it's not all about the moral issues of immigration. It's also about the financial and quality of life implications, which are all positive.
Yep. Good stuff. More of it when we get back here and right after the break. We have Richard Crouch with us in studio helping us interpret what's going on in the marketplace and where and what's happening and what you should do about it. Tom Wilson, Real Estate 360, KDOWAM 1220, Wall Street Business Network. Stick with us. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thanks for staying with us. We have Richard Crouch in the studio today. Silicon Valley entrepreneur, engineer, turn real estate investor, agent, and financial advisor. Always great to have him with us. We're reviewing, and he's giving us updates on some of the latest reports on market trends and where we're headed and what they mean.
Okay, thanks, Tom. And we just talked about where is the sales surge coming from, the first-time buyer, move-up buyers, and immigration. And we have one more category, and that's multi-generational and seniors. This statistic should put it in perspective. According to the American Association of Retired People in 2008, 5.3% of all households, or 6.2 million, were occupied by multi-generational families. That number rose to 7.1 million by 2010, or 6.1% of all households, a growth rate that's faster than the previous 8 years combined, for a total of 51 million Americans. and multi-generation options and residential care options for the aging, and also 55-plus active adult communities. Information from all of those comes from a website called LennarActiveAdult.com and LennarNextGen.com, all preceded by HTTP. Just Lennar, if you do a Google on Lennar, Lennar, I think you'll find they have a lot of really good information, again, on multi-generation housing options, residential care homes for the aging, and 55-plus active adult communities.
Factor that a lot of investors, I think, don't think about. It's not on their radar. So
that's
good
right.
You bring that up.
Yeah, that's right. Okay, so some interesting statistics here that will help you understand this dynamic real estate market and economic market that we're in. From NAR, National Association of Realtors, existing home sales report, down 1.2%, lower than the unit level last year. That's in the U.S. Prices are up 9.4%. Median price was $196,300, which was up 9.4% from 2012. Inventory is up 5%. Here in the Bay Area, it's up a whole lot more than that. Distressed sales are down, which is good news. They accounted for 14% of all sales, and last year they were 22%. Now, one of the other things that we alluded to a short while ago, but just to put it in perspective, the number of households in the U.S. and how that's going to change between now and 2017. Current households in the U.S., 121 million. So that's about one-third of the population. The projected growth over the next 3 years, 3.7%, adding 4.48 million additional households, which means that we need to provide housing for at least that many.
And I don't think we have that many vacant houses left.
No. So, where are the home values headed then with all this? I mean, we've given you a bunch of data. Well, just very, very quickly, there was a home price expectation survey conducted by Pulsonomics, and here's what they came up with from an average of 120 plus experts. Home values will appreciate by 4.3% in 2014. The cumulative appreciation will be 28% by 2018, and even the experts making up the most bearish quartile of the survey still are projecting a cumulative appreciation of over 16.8% by 2018. So your real estate portfolio 4 years from now could indeed be worth 16.8% more than it is today. Another great reason to be thinking about buying a home.
And again, that's U.S., right?
That's U.S. Okay, a little more information, U.S. related. Today's prices compared to the peak. Basically, there's an area of no decline, believe it or not, the state of Nebraska and Vermont. And then those areas where the change was the greatest was in the far western states except Oregon, Virginia, West Virginia, Illinois, Florida, Delaware, New Jersey, New Hampshire. Everyone else was in the 0 to 15% range, and the states that I just mentioned was 15 to 20% in terms of relative to the prices of 5 years ago. Okay.
We'll be right back to continue with market trends from Richard Crouch. This is Tom Wilson with Real Estate 360, KDOW AM 1220, Wall Street Business Network. We'll be right back to look at more market trends, where they're headed, what you should do about it, how it will affect you. Thanks for being with us today. We'll stick with us. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Great to have Richard Crouch back with us today in the KDOW studio talking about market trends. What do you have for us next here, Richard?
Well, I just wanted to quickly review the big numbers overall for the Bay Area and the U.S., and then talk about some of the things that are impacting median price versus average price, and then some reasons why financial reasons for buying a home. Okay. So basically in 2014, as price continues to grow, we look at 2013 going into 2014, what's going to change in terms of median price? And the answer is the projection by the California Association of Realtors is from $409,000 to $433,000 in California in 2014. So that's a increase in 9.3%.
Okay, and that's California.
That's right. And then sales of existing homes, so volume, is going to go from 430,000 to 444,000 units. So that's a pretty healthy jump. Okay. And the actual increase in 2013 as a perspective was 25.3%. So volume-wise, it is lower, 9.3% in 2014.
That 25% was volume or price?
That's the volume.
Volume. Yep. Price median was 22.5%, as I recall. But you got to be careful because the mix shifted, more expensive homes sold. And if you take a same product change, such as is done by FHFA or the sampling that Case-Shiller does, it was really more like 10.5% for one product change. And of course, there were some peak areas like Bay Area that did more. But
well, you're right on there because you're right on my second slide to talk about.
I knew that.
I'll mention it first.
That was my lead in.
You are very perceptive, I will say. And that is, we have to keep in mind median versus average price as you think about what your home is worth. And don't get tripped up by the fact that median price is a factor which measures the total number of sales above a certain price and the equal number of sales, volume of sales below that price. So if there are major shifts in where homes are being purchased and what they cost, that median price is going to fluctuate a lot. But it may have almost no impact on the average sales price, let's say, of a lower cost home. So, for example, in 2013, luxury housing market surged. In the West, up 25.4%. In the Midwest, up 36.4%. In the South, up 30.1%. And in the Northeast, up 45.3%, a major increase. So that means that the national numbers are going to be median prices a lot higher. Doesn't mean that your average price that you might sell your house for is going to be following that same statistic.
Yeah,
and then also
many people make that misperception.
Yeah, and then also a major change in jumbo mortgages, up 34%, going hand in hand with the wealthier people with more assets are obviously pushing those prices up.
Yep. Okay. And I think tracking FHFA or Case-Shiller, if you happen to be in one of those cities, is a more accurate thing to watch. Although, it's become such a median price, become such a metric that's standard. You look at that too, but you got to keep in mind what it's really referring to. We'll be back in just a moment here. Richard Crouch is with us in studio, helping us to look at market trends. This is Tom Wilson on Real Estate 360, KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Have our special guest, Richard Crouch, in studio with us today at KDOW, talking about market trends. And right now, Rich, I think you're going to tell us a little bit about what's the some of the latest stats are in various aspects of Bay Area, since we have a large number of listeners in Northern Cal. And then we're going to talk about flood insurance and talk about some factors that affect your buy-sell decisions. Okay.
Yeah, exactly. And, we just talked about the U.S. and California in terms of statistics. So let me just give you for San Francisco Bay Area, December 13, November 13, November 12, month over month, year over year, to get an idea of what's changed. So the median sold price of existing single-family homes in December 13, the San Francisco Bay Area was $666,890. And the previous year, 2012, was $598,100. So that represents in terms of volume, month over month, minus 4.5%, which pretty much all the market areas experienced a decline in volume.
In fourth quarter, yep.
Yeah. And then the year-to-year change, minus 7.5% on volume. And again, for the San Francisco Bay Area. As far as the median price for the San Francisco Bay Area, month over month, minus 4.9%, year over year, 11.5% positive. So it declined in December, but was still up 11.5% year over year. And then as far as sales volume is concerned, we just talked about that. So
I think from a forest perspective, from what I was watching, it certainly felt like, and I think most agents I've talked to, things softened. It was a very hot first, second quarter. Things softened a bit in third, fourth quarter, and they seem to be warming back up.
Yeah, and a big part of that, frankly, is the inventory situation and the expectation of good economic forecast for this year. And how much will sellers step forward and put their homes up for sale? Because a lot of those people, frankly, are going to continue to sit on their properties because they see an continued upswing in prices. So it's going to be interesting. If
I think about my mental survey of all the economists that I respect and real estate sources, I kind of would summarize as seems to be conservative optimism that we still got an upward trend this year, less than it was, but still comfortably warm.
Yeah, and of course, short of any cataclysmic or catastrophic event worldwide in this day and age that can't be immune from. Black
swan's a different ballgame.
Yeah, and hopefully Sochi has a smooth unveiling and an enjoyable time for everybody.
Yep.
One little slight tangent, although it's very relevant today, most homeowners don't know about it, and buyers need to know about it. Very, very important. Has to do with flood insurance. The rates are skyrocketing. And part of this is because FEMA is just reinitialized their flood requirements for homes that are susceptible to floods, and the prices have bumped up significantly. But even before they did, the prices were exorbitant. If you lived in a floodplain, for example, you had to pay typically anywhere from $1,500 to $1,800 a year for flood insurance. And it turns out that this applies in a number of areas in the San Francisco Bay Area. I've personally been involved with one in the floodplain that in the northern part of Santa Clara, the city of Santa Clara. And what buyers need to look into, sellers need to look into, is to make sure that they know what their status is relative to flood insurance, because that's going to be a new requirement for sellers in listing, effective immediately, and buyers need to be very much aware of it. So what has happened, though, the good news is, there is a small amount of good news. There are a lot of properties that are shown in the floodplain, which may be still in the floodplain, but they would actually not flood. Might get water onto their driveway, but would not flood. And those people are still having to pay for this insurance when, in fact, they don't need it. So there is a way to try to figure that out for yourself. Look in a map that shows floodplains, They'll be colored in blue. If you're in one of those.
Where they go? Go to FEMA website?
FEMA website should. I know the real estate locate, LOCOID, that should work with Google to get you the maps for floodplain. But I think if you just do a Google for floodplain in Santa Clara or whatever, it should come
wherever you are.
Come up, yeah. So it turns out that if you hire a land surveyor to get what's called an elevation certificate, in many cases, one that I just personally had experience with, it turns out that the maps are wrong, and for this particular property, with an elevation certificate submitted to FEMA to get FEMA to take action, the property was changed from requiring insurance to being exempt.
So bottom line is, for those that get this new requirement, don't assume that's a done deal. Go do a little research. You might get an exemption.
That's right. And I will further add that provisional insurance can be had, so you can still close escrow. You can get a provisional policy as long as the surveyor is telling you that you're likely to get an exemption. Just remember that. And call me if you have any more questions about that.
Okay. You want to start a little bit in buyers and sellers there? We just got a couple minutes, seconds here before we have to take a break.
Yeah,
and
we're going to talk about a study done at Harvard University about the financial reasons to buy a home, which, in the light of everything we've talked about here, some people might say, "Gee, this is too uncertain for me, too much of a dizzying undertaking." But the financial reasons still heavily favor buying a home.
Okay, let's look at that summary when we get back from the break. We have Richard Crouch with us in studio at KDOW, 1220 AM, Wall Street Business Network. This is Tom Wilson of the Real Estate 360. We'll be back to wrap up with some market trends today right after the break. We'll be right back. Stay with us.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Nice to have you with us today. Remember, if you can't catch your live show or want to hear parts of it again, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. And our shows for mine, as well as our co-host Joe Kachera and Laurie Graymont, you can catch on RE360radio.com. I want to remind you that on April 5, this is being broadcast in February of 2014, April 5 is a KDOW Business and Money Expo that's going to be held at the Santa Clara Convention Center from 10 to 4 p.m. We will have a table there for Wilson Investment Properties. We'll have a table for Real Estate 360. Please join us. And if you want a weekly summary of what's going on in the world of real estate economics, go to TomWilsonProperties.com and ask for that. You can also ask for a report on how to select the best metro and product to invest in. And if you'd like a free consultation from Wilson Investment Properties on where to invest your money, how to go about it, how to select what you do, or if you do invest in real estate, do let us know. So it's been great having Richard Crouch with us today. He's going to sum up a final important topic for us. But Richard, we'd like to have on the show because he is a engineer, Silicon Valley entrepreneur, analytical person who's been an investor. He's a top producer for Alain, Pinel Realtors and investment advisor representative for Transamerica Financial Advisors. He does a great job of looking at what's going on in the reports in the marketplace and summarizing for us. And Richard, before you sum up for us, they can, if they want more information from you, they can reach you at
408-391-1231. And our website is richardandcandice, Kandis.com.
Okay. Is it still a good time to buy?
It's amazing. It really is. And what I've got here is there's a study done at Harvard. Managing Director of the Joint Center of Housing Studies, Eric Belsky, created a report titled "The Dream Lives On: The Future of Homeownership in America." And there are basically 5 reasons, regardless of anything that we've talked about today, where buying a home is one of the smartest investments you can make. And this is true from a home that you would live in, also true for real estate investors. Few households are interested in borrowing money to buy stocks and bonds, and few lenders are willing to lend them the money. As a result, homeownership allows households to amplify any appreciation on the value of their homes by a leverage factor. Even a hefty 20% down payment results in a leverage factor of 5, so that every percentage point rise in the value of a home is a 5% return on their equity. With many buyers putting 10% down or less, the leverage factor is 10 or more. So here's the next 3 points. You're paying for housing whether you own or rent. Owning is usually a form of forced savings. There are substantial tax benefits to owning. So the bottom line is that we realize that homeownership makes sense for many Americans for many social and family reasons.
And for an investor, the income is totally tax sheltered in the first few years.
Absolutely. So buying homes, definitely go find a home to buy and buy before there's too much of a run-up in the markets. It's going to happen just like it does every year for the spring quarter.
Richard, thank you. Thank you for being with us today. It's always great having you on the program. This is Tom Wilson with Real Estate 360. Remember, the only thing that matters is what you do next. Look forward to having you back on the next program. Thanks for tuning in today.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.